One. Okay. Hello. Good evening. Happy Monday. Sorry for the delay. We had a little bit of technical difficulties, but we forge ahead and we are here. Thanks for joining me tonight. If it's your first time here, my name is Jackie Baker. I am a real estate agent serving the northern New Jersey area, and this is your live dose of real estate reality. Tonight, I am so happy to have back Bob Wilderotter of Guaranteed Rate Affinity Mortgage. Hello, Bob. What happened
Hey,
to you?
Jackie, good to see
There
you.
you go. Okay, good to see you. Didn't hear you for a second. All right. Thanks for coming on last minute. I know you're enjoying life in Florida right now, but that's
Yes,
okay.
it was a mob scene at the pickleball courts. Yeah,
Yep.
it was crazy. It's like Jersey Shore,
I,
4th of July. So
oh,
I gotta go
great.
on a podcast, guys. I'm going. I'm telling them.
Okay. Well, yeah, it's a good thing you're in the warmer weather. It's freezing up here.
Yes.
So hope you're enjoying yourself. Anyway, so oh my God, Bob, these friggin' interest rates. So um we saw them go, they were going down a little bit, right?
Yes.
They spiked again. They went up. No, they went down, but then
Yeah.
they went up again today. So
Yes. Yeah.
and listen, I know our friend Jerome Powell has something to do with this too. I mean, he was just, and I have the article that he was just on 60 Minutes last night talking about how they're going to really take this slow with these interest rate cuts this year. There's only going to be 3 of them, and they're going to, they want to be careful, make sure they have good data before they, lower the rates. But what, in your world, what are you seeing? What's happening? What gives with this freaking roller coaster?
Yeah. So we had, the 10-year Treasury was over 5% back in October, and then we started seeing the slowdown signals happening. And nice Stanley Cup, by the way. And then uh, we finally got down to like a 389 on the 10-year, and we started seeing rates getting into the low 6s. And FHA was also touching in the high 5s, so that was really good news. And then last week we started getting some stubbornly good economic data. So good news is bad news for rates. That's how we are. We're like undertakers. We thrive on bad news.
Okay.
But essentially, what 2 things happened was the jobs report came in way over expected, like 2 or 3 times what they had anticipated, which shocked the market. And then Powell indicated that he's in no hurry to raise rates, not to lower rates. We're just kind of have to wait. So those 2 things were disappointing to the market. But
yeah,
I was listening to another economist today, Logan Nagashami. He has a podcast actually every day.
I like him.
Excellent economist, and he likes to indicate he's like the Fed has it all wrong. A lot of old school people think you have to break the economy, you have to cause job losses and get up beyond 4% unemployment, closer to 5, and that's when they can start lowering rates. When in fact, he goes, that's just not the case at all. All the inflation, causing elements have already digested through. We had a breakdown of the supply chain. People were buying goods and service, goods when they could, then it was services when they could, and it just kept stressing the system and causing prices to rise. But that has leveled off now, but they're still squeezing, trying to break this economy further, just to make sure it doesn't allow inflation to start rearing up again. And but meanwhile, he thinks we shouldn't have raised the rates the last 1.5 points like they did, and that he expects two reductions this year. And what are they going to do? A quarter point and a quarter point? That's going to be hardly anything.
Yeah. Right.
Yeah, but it's not what he actually does, but it's what they think he's going to do. The markets are always ahead of what the Fed's doing, and the mortgage market, in particular the bond market, we're a bunch of very smart people that are forward looking, and they're trying to digest what the Fed's doing or slow to do, which is going to cause more brakes on the economy, which is therefore not inflationary. So that's
Okay.
the big sort of game we go back and forth.
Right. Okay. I mean, and let's be honest, I'm sure politics plays a role in this too, right?
Yeah, well, you think he would lower the rates already if he was trying to keep, the administration happy. You know,
Yeah.
they get lower rates, they get lower pressure on inflation, for a little bit, and certainly it's good news.
Right.
But they're not doing that yet. So by waiting till the third quarter, we're not going to feel the effects of what they do. So I don't know that it's going to do this administration any good if he hadn't started by now.
Yeah. See, yeah, I find that, yeah, that's surprising. But I mean, I don't know. Do you think waiting to the third quarter, like the timing of that, because then that brings us to, closer to November, right? By the time we start seeing the
Right,
effects
but
of it.
but the third quarter starts July,
Right.
right? And
Yeah.
so you lower a quarter point in July, it's not going to do anything. It's just psychological a little bit, but it's a long
Yeah.
way from they need, we need prime rate to be down around 5, and
Yeah.
we need, the housing market needs rates in the 5s as well. Like everyone's
Mm,
stuck in place. We're frozen in place. People
yep.
with 3% rates are not going anywhere, unless they
Right.
really, really have to. And they're, they'll be kicking and screaming, trying to get a larger house, and going from a 3 to a 6. I mean, it's like buying another house plus like an S-Class Mercedes to go with it,
Mm-hmm.
but no S-Class Mercedes to go with it, just the payment,
Right.
because
Yep.
the cost of financing is that much greater.
Yeah. Well, I mean, we've been saying we think that if we get down to say 5%, that could be the magic number for people to sell, right?
Yes. Yeah. I think, the anomaly of the 3% handle of rates, it's just that was a global crisis. That
Yeah.
was people dying, and pretty much cataclysmic. Nuclear war, like a biological or a viral bomb that that goes globally, that shuts down everything, and
Yeah.
causes mass destruction, chaos, etc. All that sort of very bad news is where you get those rates from. I don't think we want that, but I think we'd be willing to accept something in the 5s, which is kind of a normal. And then I think
Yeah.
people will feel better about, okay, 5's not as bad as 7 or 8. So they'll be willing
Exactly.
to go
Right.
ahead and move on to their next
It's all
chapter.
psychological. Yeah, but it's all psychological at that point, you know? That's why I think
Yeah,
the number 5 would work. Look, I mean,
I think so.
but I mean, even ourselves, I mean, we're talking about, down the road in a few years, like, you know what, we're gonna be selling off our investment properties, buying another place, and then we're like, oh my god, but we're giving up. We have 3% on one place and four.
Yeah,
Oh, we're gonna lose that. So I get that. I get the whole
yeah.
psychological part of it. It's like, oh crap, we're gonna give that up. Yeah, it's hard.
Well, four to 5 is not the end of the world, but 3 to 5 hurts a little bit.
Yeah,
Um, but
it does.
keep in mind though, the investment properties, the way Fannie Mae has reset the tables, the cost, the charts now charge a lot more for investment properties than they had in the past.
Right.
So second homes and investment properties, you're not going to get necessarily 5. You'd be looking at 6.5 perhaps, when people that are
Hmm.
buying a true like primary residence could be getting 5.5. The investment properties will be 6.5 to 7. They put a
Right.
lot of add-on pricing, penalties into second homes and investment properties, because
Now,
they're
can
supposed to
we
be out there
talk about
helping
that?
people buy homes.
Yeah, why did they do that? Why are they trying to dissuade people from buying the second properties?
I think it has to do with their original charter was to help promote the housing market for people to become part of the American dream and their primary residences, and that their charter does not include vacation homes and investment properties. Like they are viewing themselves as a tool to help the wealthy get wealthier. So it may have been a philosophical thing that, they're like, wait, why don't we focus on people trying to buy homes to live in and as their primary residence rather than help
Right.
people that already have a house,
Okay.
with more goodies.
Yeah.
So it's sort of a, not take from the rich
Yeah.
and
Yep.
but they're not giving to the poor. The poor are not buying houses, but they still have a chart that penalizes people that have, credit that isn't, 800. They used to just stop at a 740 credit score, and that was the best you could get. Now there's a 760 bucket, and then now above 780 to get the ultimate best pricing in the model as we price loans. Every 20 points, your credit score, 800 being sort of that magical number, every 20 points less starts to become costlier. So you go below 780, it'll cost you a quarter point. Below 760, another quarter point. Below 740, a half a point on top of the quarter. So it starts to pile on. So that once you're below, say, a 700 credit score, we start flipping people to FHA because FHA does not do that. They don't penalize really for any credit score, and which is a beautiful thing, but it's chasing people away from conventional financing because it becomes too expensive.
Right. But what kills me with FHA, right? If you don't have to put 20% down, I mean, but you could, but you still get you still have to pay PMI, right?
Yes. Yeah. So
Even if you're putting 20% down, right?
Yeah. Anyone that's FHA 20% down is because they have a credit issue. So there could have been a bankruptcy, with, Fannie Mae will only touch you after 4 years. FHA will let you get back into the game after 2 years. You can be in Chapter 13, which is in a payment plan, and you can be done for a year, and you could go out and get financing again. And we had this, on other shows where people are like, well, if they can't pay their bills, they should pay more. And my answer to that was, there are divorces, there are health issues, people have accidents, people lose jobs. So you're thinking about the people that are sort of not responsible with their credit versus life just gave them a right hook, and now they're reeling and they can't pay certain bills because they're out of work or poor health or a child or a spouse, parent are ailing and they can't work. They've got to take care of them. So that's the human
Unfortunately,
element
that
of things.
happens. Right. But unfortunately, that happens like more often than not. It happens a lot, right? And we see those situations. So
yes. Yeah. Had a client where her adult daughter died but she was sick for several months. So she left her job for 3 months to go, tend to her daughter who was like in another state. And, so she was an hourly employee. So it just messed up her average hours.
Yeah. That's hard. That's
her
hard.
credit score is not that great. She missed a few bills because she wasn't on top of it. Good person, very good person. I feel terrible. But she's going to have she got to wait. She got to reestablish her credit again to get this done. And especially if you want to buy a condo, FHA is a little more difficult to do on a condo.
Yeah. Yep. Wow. So Bob, what can we do? So as far as like the buyers, we have so many people waiting in the wings. They want to buy. The rates are holding them back. And I know what's going to happen once these rates come down. We all know, we're all anticipating the influx back into the market of the buyers. What are we telling people now? So if somebody calls you up and says, I want to get I want to get pre-approved, I want to buy a house. What are you suggesting to them? Like any strategies or?
Yeah. A couple of different strategies I look at. So we think rates are going to be in the 5s by this time next year. So when the rates were better 2 weeks ago and we started getting low 6s, at that point I was like, maybe we pay 2 points or 2.5 points and get you like 6% or 5.99, so that when rates come down in a year or so, if they're 5 3/4 or 5 5/8, you're good. Like you don't need to refinance and go through the expense and the hassle of that again. So maybe you just pay what you would have paid, for a refinance. You don't know. Suppose one of you stops working, you don't qualify anymore.
Yeah.
There's a job loss or the credit goes down the toilet. We don't know what's going to happen, but we do know at this moment in time when the opportunity presents and when the rate and the points make sense that you'll recapture the cost of that inside of like 2 to 2.5 years. I like that model. If it takes 4 or 5 years for those extra closing costs to pay themselves back in payment savings, I'm not so good on that. I don't think it's worth it. I think they'll probably may move or who knows what they'll do. But the average loan only lasts like 2.5 years anyway, which is the funny thing, except for these 3% rates.
So we're saying, so you're saying it's cheaper to do that though? It's cheaper to buy the points now versus sitting and waiting for the rates to come down and refinance?
2 weeks ago it was. Right now, it's not so much. Now
you would tell
2
somebody
points are going to get you like 6.5, right? Versus no points at about 6.9.
Okay.
Or actually, yeah. So 0 points or 2 points, and it saves you 0.5%. Now it's taking 4 years, and then I think it's better to just wait. So take the cheapest amount of point structure available, take the higher rate, and then 13, 15 months from now, you refinance it to the 5s. That's probably a better plan. So I sort of know when that tipping point is, when I've got to lean one way or the other. And I'm not afraid to give advice. I like to, if I see something I think is a win, or it's going to work out in a window I find acceptable. I've been doing this for 40 years. So I have preferences or biases as to what I think are going to work out best for the buyer.
Right. Yeah. Well, yeah. I think you know what you're talking about a little bit. So
occasionally.
So yeah, just a little. All right. So that's pretty much the plan then. I guess depending on where the rate is at the moment, you either tell them let's get points or we're going to refinance. Now, on average, what does that cost to refinance down the road? What are closing costs usually?
Well, for a purchase, I always tell people it's about 2.5% of the mortgage amount for closing costs, title, attorney,
right,
lender fees, and probably going to be paying a point. It's hard to go 0 points in this market, this type of environment. So,
okay,
but on a refinance, I would, depending on the loan size, but let's say a $500,000 loan, it's probably about 1 to 1.25% of the loan amount. Which we typically add right into the loan balance. We just build it right in instead of it coming out of pocket. When you're buying a home, everything's coming out of pocket. So you got to set up your tax escrows again.
Yeah, that's interesting. I didn't realize that you roll the cost into refinance.
Almost as long as there's room to do that, we do that. So you've amortized the loan a bit. The homes are going up in value, more than 5% a year. So if you put down 20%, this time next year, there's a good chance you're at 75% financing or 73 or 72. And then you just add the closing costs of the loan amount. There's no out of pocket. You get to skip a payment, and it's all rolled in, and you're saving several $100s a month as a result of that.
Right. Yeah. That's the big benefit to that, as we know. All right, that's cool.
Jackie, like the sad news that this market is so affected by how Wall Street looks at mortgage-backed securities. Like in all my career, when fixed rates got out of hand, they started hitting 7s or 7.5, 8. We had adjustable rates to fall back on. So if a fixed rate was at 7 and I can offer a 5-year arm at 6, that's what we do.
Yep.
But there's no adjustable rates available anymore. Like no one is buying these. And the reason is that if you look at the interest rate environment, we're still upside down on yields. Meaning like the 2-year treasury bill rate is higher than the 10-year.
Okay.
So, the shorter the term the rates, okay, these should be the 1 month treasury and the 1 year treasury and
Yep.
2 year, 5 year, 7/30, 10/30. Instead, it's like this, because the lower rates are higher than the longer term rates. So you can't offer adjustables which are gauged to shorter term rates. So we don't have that normal slope, and therefore the adjustables, if there are any, and they're available on the big jumbo loan amounts that are going to the portfolio lenders of the world, it's only an eighth better. It's an 1/8% better. So I can give you, 6.5 on a 30-year fix or 6 3/8 on a 5-year ARM. Like, why would you just wouldn't do that.
Right.
It doesn't make sense. The reward for the risk isn't there.
So do you think it will ever go back to that, like to become more
Now,
normal?
those people that did take it, once we get the curve, once the Fed starts lowering their rates, because inflation is, the recession is what worries the rates. When the short-term rates go up, they think there's a recession coming. When the rates normalize, that means that the economy is sloping correctly, left to right, it's going upward. The economy is getting better, it's growing, and the inflation is contained, and that's your perfect environment. Shorter term rates are cheaper than longer term rates. That's the way it normally should be. It's not that way right now.
Okay.
And it hasn't been that way since COVID.
Well, let's hope we get back to that.
Yep.
But you see a lot.
I think at that point the fixed rate should cure themselves. The fixed rate are in the 5s, and you can get, let's say the adjustables do come back, Jackie, and let's say like you could do a 5.5 on a 30-year fix and a 7-year ARM at 5 1/4. Would you do that? I don't think I would. I think
no.
I would think that I would just take the 30-year fix all the day. It's not enough reward to do that.
Yeah, I mean, I'm not a fan of the ARM loans. I know you and I have had that discussion. But yeah, I mean, give me a fixed rate any day.
It worked out always till now. They're not. A lot of people are calling me where their 7-year time frame is up, and their rate just went up, from like 3.5, 4 up to 8%, and so they're talking about, what do we do now? I mean, I could refinance you into the 6s, where you can just wait it out another 12 months, see what happens. Maybe get a lower rate.
Oh my God. You see there's my reason why right there. That's why I wouldn't do it. Would never do more.
Yeah, but it had always been a good thing. When I was selling adjustable rates, they were adjusting down after the 7 and 5 year period of time. Everyone thought I was a genius. And it just, they caught it right, like right when COVID hit, and the Great Recession had the indexes at like 0, so that people were flatlining at 2.5 to 3%, and I thought it worked out great.
Yeah, no, now not so much. That's a little scary. I mean, do you think that's going to cause people to maybe, it's scary to say, to default? They're going to default now on their loans now. If they had like 3% or 4%, now that's going to be over 7%. I mean, do you think it would get that bad?
Default rates are really low. There's not a lot. I think we talked about this, like after when COVID hit and they did the forbearance packages, you can stack up your payments for 3 months or 6 months or 9 or 12. That stopped a lot of foreclosures from happening. Now I think they're creeping up a little bit, but by no means do I think that there's like a big pile of them waiting to push through.
Yeah, but I think what's causing the uptick, aren't these like foreclosures that were like in the works prior to COVID, and there's just been so much backlog, and the forbearance kind of, people who went into forbearance, that just added to the queue.
It's the forbearance where they never got back on the horse again, like they never got back to work. Their health declined, and they just couldn't get back and work.
Right.
Is what could happen. Job loss, or just they just got used to not paying and just didn't budget, to start making those payments again. I mean, there's people in their houses 6 and 7 years not paying a dime.
Oh my God. I
Yeah.
could never listen, I wanna judge. I wanna judge. I'm not trying to judge anybody, but oh my god. I don't know what the hell I would do. I could never do that, to be that long like, that long without paying off my loan. My god, it's just the thought of it stresses me out.
But
Um,
I know the VA loans, the veteran loans, I
yeah,
was talking to another agent that the VA loans, they're pushing them out to 40 years, those that can't get back on their feet. And I'm like, this seems like optics to me that no one wants to foreclose on a veteran ever. Okay, that's number one.
right.
It's just bad
Yep,
optics.
yep,
Number two is if there's a lot of these veteran loans going bad, it's really bad optics for the administration. If they start crying, oh, look at all these veterans losing their houses.
yeah.
So they've come up with ways to just cut their payment anyway, lower the rates, just keep these veterans in these homes so that there's not a lot of bad publicity.
But they were that 40-year option, that was also for FHA also, right? Those are for but that was only for people who were missing payments. They allowed them to go back and reset, redo the terms to 40 years, right? That wasn't just VA, it was FHA as well,
Well,
if I
it was a
remember
conversation I had with one of your colleagues that sees like when she talks to these investors when they're going to package these loans, that's what's coming down the pike. So some of these she has to appraise to let the VA know where these homes are worth as they're
Okay,
about to package them with the new reset. So she's
okay,
noticing that.
okay.
Hmm.
Interesting.
Yeah.
Ugh. Yeah, I just saw, I think it was Newsweek. It was a couple weeks ago. So there's this, let me step back. There's an agent who's been on he's been on a live stream with me, Jim Flanagan. He's a Calder banker down at Tom's River. And he's awesome. Like he does all these reels and TikToks and stuff. And he shared an article from Newsweek saying that um New Jersey was seeing a rise in foreclosure starts. And of course, when you go in and, dig deep into the article, it's all the ones that were backlogged, the ones that couldn't get into the court systems prior to COVID, right? They were ready to get going, but then they
Yeah.
were stopped because
Yeah.
of COVID. And New Jersey, it takes 3 years, right, to get through the foreclosure process. So
Yeah.
I just thought that was so funny. So, Jim brings this up. He does a TikTok about it, and it's funny, and of course, it goes on in the article to say that we're not saying that the housing market in New Jersey is crashing. There's just been an uptick. Like they had to like go back, backtrack what they were saying. But the headline was, New Jersey's in trouble with foreclosures, and yeah, it's like you said, there's like the foreclosures, the defaults are really low. But it's just funny. Like I think people are just desperate. Um, they're desperate for that to happen because they want to be able to buy a foreclosure. You know. Anyway.
Yeah. I mean, they're out there, but the houses are, can be beat up pretty badly.
Yeah.
Um,
Yep.
and
Yeah. One.
it's hard to do. You got to be good at it. It's like jumping on a moving train. You got to be really ready to go and
Yep.
know what you're
Yep.
doing. Make sure the title's clear.
Yep.
There's a lot
No,
of
it's
hazards to doing that. Hidden, buried oil tanks that were never addressed. So you could just be buying someone else's problem, and then you go down the tubes.
I know. And it is funny because one of my most watched videos right now here on the channel, I did a video about, places where to look where to look online to find foreclosed properties. People are interested in buying. Well, I did a video here you can find them. That's becoming my most popular video right now. And it's like it's interesting because it's like, oh God, here we go. People are banking on I don't know if it's because people are banking on what they're seeing in the news, or you're hearing, this talk, these rumors that, oh, people are gonna market's gonna crash, people are gonna foreclose. Or it's just people that want to get a house, they can't afford something, they can't afford the average house that's currently on the market. And it's like, oh, let me look for a foreclosure. I just found it interesting how all of a sudden within the past month, the views on this video skyrocketed. I'm like, oh boy, here we go. It's one of two things.
Yeah.
And I just don't want people to get disappointed, because like you said, it's not an easy thing. It's not an easy thing to do. I did a foreclosure years ago with this investor. Well, it wasn't an investor. They were buying it for themselves, but he was a builder investor, and it's not fun. It's not fun when you go through the process of the inspection. when you walk in, like, and you have to get that inspection done like right away. As soon as your offer is accepted, like within days, you have to have the inspection. And then you got to make that decision whether you're going to move forward or not. If everything looks okay, like, all right, we're going to move forward. But like you said, you are taking on somebody else's problem, and you may miss things in that inspection because you're
Yes.
rushing through it, only to come to closing, and then you got a big mess on your hands. So there's a lot of risk. It's just a lot of risk involved. Not saying it's a bad thing, but you gotta know what you're doing. You gotta have the right people. If you're not a builder, you're not handy, you gotta get the right person to help you with that. Because you could be costing you so much money after you buy it. But anyway, that's my
Yeah,
little
you got to be like, we have a home inspector that's also an FHA consultant, a HUD consultant for our renovation loans. So they have staff. If there's a client of yours that wants to locate an estate sale, or
Mhm.
a neglected house, or a foreclosure, bank owned, bring that person in. They'll do the inspection, like, what has to be done and what you'd like to have done, so the house really pops in value. And
Mhm.
then what the budget's going to be, so you can make an
Right.
informed decision. So you're not like, broadsided that, yeah, I budget only 125,000. This ends up just going to be a $300,000 project.
Yeah. Yep.
Um,
Yeah, that is
so they'll
key.
help you sort of manage expectations and know what to expect, and then make sure you have a contractor on hand that's going to be able to give you quotes that are realistic.
Absolutely.
Um,
Absolutely. And a lot of people I had
the other thing you've heard about. Go ahead.
No, 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 go ahead, go ahead. Go ahead.
Condos, condominiums are,
Yeah.
starting to, they're getting older.
Yep.
I'm seeing one of your YouTube stars down there, one of your compadres, talking about the Florida coast, these old condos that, are on A1A on the East Coast, and these buildings are 50, 60 years old, position
Uh-huh.
A, but they were bought by little ladies, like 30, 40 years ago. And, their
Yep.
maintenance fees were next to nothing. The taxes are next to nothing. Now, all of a sudden, after that building collapse, and after all the
Yeah.
hurricanes that hit, the insurers are not insuring these buildings. So they got to go to market, and, you know, and they also have to put together a capital reserve account to get these buildings, brought up to code. So
Mhm.
the assessments could be millions of dollars on 50 homeowners, right? So that's going to be a problem
That's
there. And
outrageous. Oh, I know.
yeah,
I know. Well,
yeah,
yes, Florida's getting super expensive. It really is.
it is.
You know, it's just amazing. Like, everyone flocked there. Now, well, you have all these problems, and all these insurance companies that left the state. They're not writing policies anymore. And I talked about this last week too with the rising insurance costs. It's like, holy crap, it's bad. It's really bad. Like, I don't know if you caught it last week, but I was talking
Yeah.
about how a mom on the Bergen County Facebook page was talking about how she just bought her house, and 6 weeks after closing, the insurance company dropped her because they said her roof is too old. It was only 15 years old, and they said, "You gotta replace the roof." So then she's like, "Forget that,"
Really?
and she found another insurance company, and I think it was, like, just a couple of months, she just got a notice again, they're canceling her policy because the roof is too old. So,
It,
I
I thought
mean,
it was 20 years,
scam?
but 20 years was the number.
No, 15. Like, is
But
this a
I
scam,
can see
or is
they're
this, like, a
doing
new
that because,
thing?
that's where the damage comes from.
Yeah, roofs
They're
last 20,
trying
25
to.
years
That's where the
easily.
damage. That's the 30 years, but they they're not doing it. I know that one of my friends owns an agency, and a big brand, and they're not writing new policies. And there's
Yeah.
several big brands, if not more than several, are not writing new policies for existing clients. Yes, they're keeping what's in place, but they want to jack up the insurance rates, and
Yeah.
until the state of New Jersey lets that happen, they're not taking on new business. And
God.
then the condos, if they have too many claims, that happened to one in here in New Jersey, which I'm not going to mention, but their policy that they had to go to market and get is just really poor coverage. It's like got a $250,000 deductible, and it excludes certain things, and it also is, I think, 5 times the cost of what they had in place earlier. So it's a double, triple whammy. And plus all these buildings, especially on the Hudson River, like Edgewater, Fort Lee, Hoboken, they're all on the salt water right there, right? So they have to replace a lot of their structure because the salt air gets in there, penetrates, and so they have to put the rebar in there, whatever they're doing, re-window everything, re-side, re-roof, everything. I think there's a huge project in Jersey City. It has a $50 million assessment, so they're putting a whole new skin and roof on the buildings and windows and everything because the salt air just eats away. Yeah, it's beautiful, but everything comes with a price.
Yep, exactly. So, anyway, does anybody have any questions or comments? I see Anthony. Anthony's commenting about about the piano in your background there. What background do you have?
That's not me. I'm at my sister's condo right now. I'm like, I didn't even notice that. No, there's no piano here.
Gotta love the green screen thing, whatever, right?
It's a fake background.
Fake background, Anthony. So anyway.
Yeah, sorry.
So all right, so Bob, before we wrap up, okay, so basically if somebody's looking to buy right now, it's either they buy points or depending on where the rate is, you tell them to hold on and then wait for the rates to come down, refinance when the rates come down. That's pretty much what you're telling people. I mean, is there anything else that people should be doing?
Larger down payments help. So 25% down gets you a better outcome on your rate than 20% down is kind of they hit you hard for that for some reason. Like 10 and 15% down is slightly better because you're taking PMI. And then 20% down is cost a half point more than if you put 25% down on the cost of financing.
Why? I don't understand that.
That's the chart. That's sort of the sweet spot is 25 and 30% down. That helps keep your credit scores above 760.
Yep.
I'll point out that, if you're thinking about, going out there to buy a home, we do what's called a soft pull. It means we're not leaving any fingerprint on your credit report. Yep. It's not going to cause it to drop because we looked at it, and it's a soft pull. So we can identify that, oh, look, your credit card balance over here is too high. If you pay that in half, your score will go up 20, 30 points. So we can help guide you to get the best outcome possible. So that'll help, squeeze out more savings. The other thing is we offer a lock and shop. So if someone's like locking in, like I would tell everyone, lock in today. Rates are better by the time you close and they drift downwards. We'll let you break the lock and go to a lower rate. That's a win-win.
It is a win. I love that. I love that you guys offer that.
Yeah.
That's such a
and
huge
like people
thing.
Like, I don't know. And two of my clients, like they got that. It really does. It's for real. So they were, in the mid 7s when I took their loans in October, or actually higher. And then they closed in December when the rates really dropped, and I got them 0.75% lower than what they had.
Oh God, that's great.
They were thrilled. It's saving like $200 a month.
Oh my God, that's awesome.
So yeah,
good.
So that's sort of FOMO thing. Are you going to cry more if you lock in today and rates are better? Would you cry? Yes, but would you cry more if you waited to see if rates got better and they got worse?
Yeah.
And you could have had something and then you didn't get it. I think most people would be upset by that.
Yeah.
So I'd like to get you out of harm's way, and it can only be better.
Yep.
By doing the way our lock works. Most lenders do not do that. You got to threaten to leave them. You got to like really just get nasty to try to get them to hear you that I'm going to just bounce somewhere else and get my mortgage somewhere else. I'll pay the appraisal all over again because I'm going to save 0.5%. why
Yeah.
aren't you going to work with me here? We already have that, already built in, so that, they don't have to worry about this at the last minute.
Yep. Yep. No,
So
that's good.
that's huge in my book.
Yeah, no,
Yeah.
I really love all the products you guys offer. It just makes life easier for the clients, and you're saving the money too. That's like the bottom. That's the win that we want for everybody, right? Especially in this market.
Yeah, and then
So
we can lock rates without a house too, but I don't really normally like to do that because don't know when you're going to find a house. But if rates, if this was last summer and rates were starting to go up, you could have locked in a block of money for $500,000 or 600,000, whatever it may be, and protected that rate for 60 days or 120 days. And if
yep,
rates were 8% by the time you found a house and you still had that 6% locked in, who's the
yeah,
genius now?
right.
But right now, I don't think that's necessary. I think the trend's going to be downward, but it's just going to be painstakingly
Gonna
slow.
take time.
Yeah.
Well, let's see what happens. So maybe the spring market is going to start a little later. I think at those rates, if they wait until the third quarter, I think that's when things are gonna kind of blow up. But
Yeah,
we shall see. We shall see. Every day is a new day.
we shall. Thanks, Jackie.
Bob, thanks so much for being here. I appreciate it. And for those of you watching, I will leave Bob's information in the description box. Feel free to reach out to him if you want more information about getting a mortgage. And if you need my assistance, feel free to reach out to me. I would be happy to help you. So thank you all for joining me tonight. And I'll see you next Monday. And don't know what we're talking about yet, but I'll post it. I'll let you know. All right. Thanks again, Bob. Appreciate it.
Bye. Thank you.
All right. Bye.